Two top investors independently announced in November that they have taken positions in Union Pacific. And for me, that's obviously a reason to take a closer look at the stock to see if it's a good investment. On the one hand, Seth Klarman has built up a position in Union Pacific, weighting it at 7.43% or 353 million US dollars, making it one of his largest positions right from the start. And that shows that he is clearly convinced there is a significant undervaluation here. Daniel Loeb also bought in the past quarter, making it a new addition to his portfolio as well. His weighting is a bit lower at 2.49% or 200 million US dollars, but it's still a significant allocation, and he too sees considerable upside potential here. If we look at the long-term development since the year 2000, we can see that the stock price has been steadily rising over the long term. Here, that's a plus of 2,100% over the past 25 years or so. But there have also been fluctuations. For example, in 2008, during the global financial crisis, the stock price dropped by about 60%. In 2015 as well, the stock price fell about 50% from its peak. Then, of course, during the corona crash, the stock price dropped rapidly, again, almost 50%. And most recently, in 2022, it dropped about 30 to 35% from its peak, and it's still below the all-time high, about 20% lower, with the current price at $222, while the high was around $280. The current market capitalization is 132 billion US dollars, and they also pay a quarterly dividend. Most recently, it was increased from 134 to 138. And if we take a quick look at an overview, we see that the PE ratio is currently around 19. Most of you are probably familiar with the company. This is one of the largest railroad companies in the western United States, and they have a huge rail network spanning across the USA, except for the eastern part of the country. Altogether, their rail network passes through 7,000 communities in 23 states. And with that, of course, you have an enormous economic moat because no other company can build such a large rail network so quickly. What does that mean in numbers? They have 32,880 miles of rail network. They have 7,000 locomotives in operation, almost 33,000 employees. The rail network includes 16,900 bridges and also 30,000 railroad crossings. So it's truly a huge rail network that ensures freight transport across large parts of the USA. But let's take a look at the numbers. What does the long-term development look like here? On the one hand, we see that revenue has risen from $21 billion in 2012 to now $24.5 billion. So we don't have any significant growth here because, of course, you can't just keep building more rail networks and connecting more cities. After all, the market is naturally saturated. There are still one or two other major railroad companies in the U.S., so you can't really expand much here. You can only scale up a bit with volume. And of course, with prices, which are always adjusted, for example, to compensate for inflation. And that's easily possible because they have such a strong moat. Net profit has increased disproportionately from about $4 billion to $7 billion, since back then the net margins were just under 19%, and now they're at a phenomenal 28.7%. Earnings per share have risen even more sharply from $4.17 to $11.79 because they're also buying back a significant amount of shares. In 2012, there were still 946 million shares outstanding. Now there are just under 600 million. So they've bought back more than a third of their shares over the past 13 or 14 years. And then there's also the dividend. This too has been continuously increased here. Back then, it was $1.21 per share, and now, calculated annually, it's well over $5 per share. So in the long term, you have a good company here, one that has developed very well with a strong moat. But of course, that doesn't mean it's currently undervalued. That's something we want to take a closer look at over the course of this video. And for that, we'll take a look at the latest quarterly report. Here we can see that revenue recently stood at $6.24 billion US dollars, which is slightly higher than a year ago. Back then, it was $6.09 billion. Net profit also increased slightly from $1.67 billion to $1.79 billion. And earnings per share were able to increase disproportionately since shares continue to be bought back from $2.75 to $3.01 in the last quarter. And the number of outstanding shares has also decreased by about 2.5% within a year, from 608 million to now just 593 million. We see a similar picture when we look at the entire first 9 months of the year. Here, too, there was a slight increase in revenue from $18.1 billion to $18.4 billion. Net profit also increased from about $5 billion to $5.3 billion, and earnings per share rose from $8.18 to $8.87. So the current year is also going very well, but what we have here is not a rapidly growing company, but rather a steadily growing one with a strong economic moat. Of course, the financial situation is also important, and we can see they have $800 million in cash, while on the other hand, there are short-term financial liabilities amounting to $1.5 billion and long-term financial debt totaling $30 billion. So what we have here is an extremely high negative net cash position. However, it should also be noted that they own the entire rail network in the U.S., which obviously has significant value. For example, the whole thing is recorded on the balance sheet at $59 billion, so there is real value here to offset the financial liabilities. However, you do have to pay interest on those financial liabilities, and those interest payments, in turn, reduce profits. And what ultimately remains for the shareholders? To answer that, let's take a look at the cash flow statement. In the first 9 months, they generated about $7 billion in operating cash flow. Of that, they needed $2.8 billion for investments. That means about $4.3 billion are left for the shareholders. And what do they do with that? On the one hand, they paid out $2.4 billion in dividends, and on top of that, they used another $2.7 billion for share buybacks. That adds up to a little over $5 billion, which is actually a bit more than the free cash flow. Where's the rest come from? Of course, they take on new debt, $2 billion, but only pay back old debt to the tune of $1.4 billion. That means the debt level has increased a bit here. But last year, things looked different. Back then, they paid back a bit more debt, $2.2 billion, and only took on $800 million in new debt. In return, there were a lot fewer share buybacks, so it kind of balances out over time. We can also take a look at the last 3 years as a whole, since 2022. Here, we're also looking at the cash flow statement, where, for one thing, share buybacks fluctuate a lot. In 2022, they spent $6 billion on share buybacks, but in 2023, it was only $700 million. But in 2022, they took on $6 billion in new debt and only repaid $2.3 billion. So the debt level also increased significantly here, and in 2023, things look different. And in 2024, share buybacks were increased a bit, but still carried out at a much lower level than 2 years before. Ultimately, I'm personally not a fan of conducting share buybacks by taking on new debt. Personally, I would really only use free cash flow for that, and I'd actually prefer to reduce the debt level a bit more, even if that means scaling back share buybacks or maybe even the dividend. That way, in the long run, you have a lower debt level, have to make fewer interest payments, and ultimately achieve higher profits over time. And if you're new to my channel and looking for more professional stock analyses, feel free to subscribe to my channel and activate the bell so you won't miss any of my videos. Next, let's take a look at the valuation levels over the past years, starting from 2011. And at the very bottom, we can see the development of the PE ratio. At the very top, we see the development of the stock price, and in the middle, we see the earnings per share. And if we take a look all the way at the bottom, we can see that in 2012, the PE ratio was about 11. In 2014, it went up to 15 or 16, and then it dropped a bit again. Here in 2015, the PE ratio was back at 11, and then it went up again to 16. Here, it dropped significantly in 2017 and 2018, but that's because of these special profits, which were much higher than usual. That's why we can just leave that out for now. And then, after the corona crash, the stock price shot up. The PE ratio was then over 25, and since then, it's come down a bit again. But currently, the PE ratio is still around 19 to 20, and for a slow-growing company, that's not really that cheap in my opinion. Analysts also expect earnings per share to continue growing in the coming years, but still only at about 7 to 8% annually. So not a whole lot, but not too little either. And the earnings per share are expected to rise from $11.76 to $12.68, and then in 2027 to $13.46. And if we now look at all this in my Excel tool for stock valuation, we can see, for one thing, that we have earnings per share of $11.76 here. That's the profit that analysts are projecting for this year. And we have negative net cash of $52. Then they also have some long-term investments, which I've included as well, but those are only about $3.30 per share. And if we take this position into account, we end up with an adjusted PE ratio of about 23, which makes Union Pacific look even more expensive than it did originally. And if we assume a normal scenario here with 7% annual earnings growth over the next 10 years, a payout of 50% of earnings as dividends, and a fair PE ratio of 13 or rather 12.8, then we only get an annual return of 3.5%. Why did I use 12.8 as the fair PE ratio here? Because I don't see the company as a fast-growing one, but rather as a moderately growing company. And that's why my valuation tool comes up with a relatively low fair PE ratio here. And as we saw earlier, such a valuation level has occurred several times over the past 15 years. But we can also assume a positive scenario where earnings grow by 10% annually over the next 10 years, the payout ratio is a bit higher at 60%, and the PE ratio is 20. In that case, the share price would be $561 in 10 years. The dividend, which would add up to $96 over the next 10 years, would mean an annual return of 11.4%. That sounds good. However, in my view, that would really be the positive scenario. And for a positive scenario, that's just not enough for me. I would expect such returns more in a normal scenario. And what happens if everything goes badly? If profits only grow by 4% per year, the payout ratio drops a bit, let's say to 40%, and the PE ratio is only 10. That has happened in the past as well. In that case, the share price in 10 years would only be $125, which is $100 lower than it is now. The dividends would add up to $46, and in this case, we would have an average negative return over the next 10 years of minus 2.6%. What if the share price dropped from $223 to, let's say, $125? In that case, the valuation level would be at an adjusted PE ratio at just under 15, and the scenarios would look much better. And these would be price levels where I personally would invest, because from my perspective, the risk-reward ratio looks good here. But there is some news that could change things a bit. Specifically, this was announced on July 29th of this year, and Union Pacific and Norfolk Southern want to merge. More precisely, Union Pacific is seeking to acquire Norfolk Southern by, let's look down here at the specific terms, offering 1 share of Union Pacific stock for each share of Norfolk Southern, plus an additional cash payment of $88.82. This means that Norfolk Southern shareholders would receive about $320 per share, and for that, Union Pacific would have to issue 27% more new shares and, of course, take on new debt to pay out the cash portion. So there would be more debt than before. At the same time, the whole thing would be somewhat diluted due to the issuance of new shares. In return, of course, you also acquire Norfolk Southern as a company, which has a certain value. From my point of view, this makes sense if you can get Norfolk Southern at a good price. But even here, the current valuation level is over 20 in terms of the PE ratio, which, in my opinion, is not cheap. All in all, the two top investors seem to see something that I might not see. For me personally, the expected return here is too low and the risks are too high, which is why I'm not investing. If you want to know which stocks I'm buying instead, feel free to check out my latest community portfolio update. I bought several stocks there, and until next time, this is the German Value Investor.